Welcome back. Today, we are discussing a topic that sounds boring on the surface, but is actually one of the most dangerous traps in the entire banking system. I'm talking about the battle between the offset account and the redraw facility. Now, I know what you're thinking. Oh, come on, they're basically the same thing, right? That is exactly what your bank wants you to think. In fact, if you walk into a branch today and ask for an offset account, there's a high probability the teller will say, "Why pay the annual fee for an offset? Just use the redraw facility." It does the same thing. It saves you interest. The source material we are reviewing today explicitly warns against this advice. It suggests that mistaking these two products can have severe consequences for your financial future. Today, we aren't just going to define terms. We are going to simulate the life cycle of a loan to show you how choosing the wrong one can destroy your tax benefits, lock up your cash when you need it most, and send your accountant into a mental breakdown. Buckle up. We're diving deep. Segment 1. The illusion of same. Let's start with the basics. Why is there so much confusion? The confusion exists because, mathematically, the immediate result of both products looks identical. Let's take a hypothetical scenario. You buy an investment property for $500,000. You put down a 20% deposit, so you have a loan of $400,000. Now, let's say you have a spare $10,000 in cash sitting around. You want to save interest. Option A, the offset account. You put that $10,000 into the offset account. This is a separate transaction account linked to your mortgage. The bank looks at the $400,000 loan, sees the $10,000 offset, and says, "Okay, we will only charge you interest on $390,000. Option B, the redraw facility. You dump that $10,000 directly into the loan. The loan balance drops from $400,000 to $390,000. The bank charges you interest on $390,000. On day one, the cash flow effect is identical. You pay less interest. This is why bank staff, who are often incentivized to sell simple, low-cost products or simply don't understand tax law, will tell you they are the same. They will point out that an offset account often comes with a wealth package fee of $300 or $400 a year, whereas redraw is often free. They'll say, "Save the $400 fee. Use the redraw." But here is where the advice becomes dangerous. While the math is the same, the legal nature of the money is completely different. And in the world of tax and asset protection, legal nature is everything. Segment 2. The sponge versus the sidecar. To understand this, I want you to visualize two different objects. Think of an offset account as a sidecar attached to a motorcycle. The motorcycle is your loan. The sidecar travels with it. You can put your money in the sidecar. The heavier the sidecar, the easier the engine works. But at any moment, the passenger can jump out of the sidecar and walk away. The money in the offset account is your money. It sits in a separate vessel. Now, think of a redraw facility as a sponge. The loan is a dry sponge. When you put your $10,000 into a redraw facility, you are pouring water into the sponge. The water is absorbed. The sponge gets heavy. Here is the critical distinction. Once you pour that water in, it is no longer your water. It has become part of the sponge. The bank technically owns that money because you have used it to pay down the principal debt. Yes, the bank gives you a redraw feature, essentially permission to squeeze the sponge and get the water back out. But as we will discuss later, the bank can decide to stop you from squeezing the sponge. And more importantly, the Australian Taxation Office treats the water you squeeze out very differently from the passenger getting out of the sidecar. Segment 3. The tax trap, the $20,000 mistake. This is the part of the episode where you need to pay close attention. This is where 90% of amateur investors fail. Let's go back to our example. You have a $400,000 loan on an investment property. You had $100,000 in cash, and you wanted to save interest. Scenario 1. You used offset. The $100,000 is sitting in the sidecar. 2 years later, you decide you want to buy a new car for yourself. A nice, reliable SUV for the family. You take the $100,000 out of the offset account and buy the car. What happens to the loan? The interest is now calculated on the full $400,000 again. But here is the magic. Because the loan was never paid down, the purpose of a loan remains investment. The interest on the full $400,000 is still 100% tax deductible. The ATO is happy. Your accountant is happy. You have a new car, and you have maximized your tax deductions. Scenario 2. You used Redraw. You put the $100,000 into the loan, just like the sponge. The loan balance dropped to $300,000. 2 years later, you redraw that $100,000 to buy the same car. In your head, you're just taking your own money back. In the eyes of the ATO, you have just engaged in new borrowing. Because you paid down the debt, the loan was extinguished by $100,000. When you pull it back out, you are creating a new loan of $100,000. And the ATO asks one specific question. What was the purpose of this new borrowing? The purpose was to buy a personal car. Personal debt is not tax deductible. So now, you have a $400,000 loan. But only interest on $300,000 is tax deductible. The interest on the $100,000 portion is contaminated. And it gets worse. This is what we call the accountant's nightmare. If you just pull out a lump sum of $100,000, it's bad, but it's calculable. But what if you treat your Redraw facility like a transaction account? What if you pull out $4.50 for a coffee, then $63.85 for groceries? Then you put $500 back in from your paycheck. Then you pull out $200 for dinner. You are churning a loan. You are mixing investment debt with personal spending. Come tax time, you hand your bank statements to your accountant. They will look at you with tears in their eyes. They cannot simply separate the interest. They have to apportion every single day's interest based on the percentage of the loan that is private versus investment. Most accountants will charge you thousands of extra dollars to figure this out. Or they will simply tell you that you've lost your deductibility entirely because the loan is too contaminated to salvage. As the source text emphasizes, using Redraw for personal expenses destroys the tax purity of your investment debt. Using Offset does not. It is that simple. Segment 4. The control factor. Who owns the cash? Now, maybe you're listening to this and thinking, I don't care about tax. I just want to pay off my house. Fair enough. But let's talk about risk and control. We mentioned earlier that offset money is your money, and redraw money is bank money. This distinction becomes critical during an economic downturn. In a standard offset account, that money is a deposit. It is governed by banking guarantees. You can access it via an ATM, a debit card, or an app instantly. It is liquid cash. With a Redraw facility, you're relying on the bank's permission to give you the credit back. If you read the fine print of your mortgage contract, the stuff printed in size 6 font that nobody reads, there's almost always a clause regarding redraw. It will say something like, the bank reserves the right to suspend, cancel, or reduce your redraw availability at any time without prior notice. Let that sink in. Without prior notice. When does this happen? It happens when the economy gets shaky or when property prices fall. Let's go back to our example. You bought the house for $500,000. You owe $300,000 because you paid $100,000 into the redraw. Suddenly, the market crashes. Your house is now worth $450,000. The bank gets nervous. They want to ensure their loan-to-value ratio is safe. They might look at your account and say, we are no longer comfortable letting you pull that $100,000 out because if you do, your debt will be too high compared to the falling house price. They can lock the redraw. So, you assume you have $100,000 in emergency funds sitting in your mortgage. You lose your job, or you have a medical emergency. You log in to transfer the money, and the available for redraw balance is 0. The money is gone. It was used to pay off the house, and the bank has decided not to lend it back to you. If that money was in an offset account, the bank cannot touch it. It is your cash asset. Even if the house value drops to 0, that cash in the offset account is yours to withdraw. This is the security premium. This is why experienced investors are happy to pay a $395 annual package fee. They aren't paying for a bank account. They're paying for insurance against bank policy changes. They are paying for control. Segment 5. The strategy. How to structure your accounts. So we've established that redraw is risky and tax inefficient for investors. Does that mean redraw is useless? Not necessarily, but you need to know where to use it. The general rule of thumb from our source material is this: flexibility is king. If you are an investor, or if there is even a 1% chance that your current home will become an investment property in the future, you should almost always opt for an offset account. It keeps the loan balance high, which maximizes future tax deductions, while keeping your net interest payable low. It keeps your cash separate and clean. The PPOR priority now. Let's talk about where to put your cash. This is a common question. I have a home loan, which is a bad debt, and an investment loan, which is a good debt. Where should I put my offset money? The answer is almost always the home loan. Why? Because the interest on your home loan is not tax deductible. It comes out of your after-tax income. It is the most expensive debt you have. The interest on your investment property is tax deductible. The government effectively subsidizes that interest rate by your marginal tax rate. So you want to offset the bad debt first. You want your home loan interest to be zero, while your investment loan interest remains high and deductible. However, and this is a big however, make sure you have the structure right. Many people make the mistake of having an offset account on their investment property while they still have a massive home loan. They are effectively saving 30% less than they could be because they are offsetting the wrong debt. But remember the golden rule of the ATO: purpose is everything. If you ever refinance, or if you ever pull money out of a loan, the ATO doesn't care which house secures the loan. They care about what you did with the money. Did you buy a TV? Not deductible. Did you buy shares? Deductible. Did you buy a car? Not deductible. Did you pay for a renovation on the rental property? Deductible. Using an offset account makes tracking this purpose easy because you're spending cash. Using Redraw makes it a forensic accounting disaster. Segment 6. Conclusion and action steps. We've covered a lot of ground today, so let's summarize the key takeaways to protect your portfolio. Don't listen to the teller. The person at the bank counter is trained to sell products, not to give tax advice. When they say redraw is the same as offset, they're speaking about interest calculation, not tax law or asset protection. Preserve deductibility. If you ever plan to use your cash for personal items such as holidays, cars, or weddings, keep it in an offset account. Never put it into the loan from redraw unless you're 100% sure you never want to see that money again for tax purposes. Protect your liquidity. In uncertain economic times, cash is king. An offset account guarantees access to your cash. A redraw facility is subject to the bank's discretion and property valuations. Keep it clean. The ATO loves simplicity. An offset account keeps your personal spending separate from your investment debt. A redraw facility mixes them up like a blender. Don't give your accountant a reason to charge you extra fees. The difference between these two accounts might seem like a minor technicality. It might seem like just a $400 annual fee difference. But over the life of a 30-year loan, the cost of making the wrong choice can be tens of thousands of dollars in lost tax benefits and the potential freezing of your life savings. Real estate investment isn't just about buying the right house. It's about financing it correctly. It's about the boring paperwork that protects your wealth. If you're currently using a redraw facility and treating it like a savings account, I highly recommend you speak to a qualified mortgage broker or your accountant this week. You might be sitting on a ticking tax time bomb. If you found value in this deep dive, please share this episode with a friend who is looking to buy property. Friends, don't let friends use redraw on investment loans without understanding the risks. Thanks for listening, and I'll see you in the next episode. 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 You in the next episode.